Welcome. Thank you for joining us today. If you're a home host and you think today's topic is not a concern for you, you are wrong. Tax issues, that's what we're talking about today. Tax issues for home hosts. It's not the same as your regular tax scenario before you were earning income hosting guests. And so there's special kind of nuances that you need to know about so that you stay lined up and in alignment with the IRS, which is what we all want to do. I'm bringing on an expert today because this is not my expertise. This is Katrina Martin. She's coming in. She's a two-time author. She's got a book out there called Airbnb Secrets and another book that she's a co-author in, Reputation Driven. We're both in that book. So I'm going to bring her on. She's going to tell us everything we need to know, everything we need to watch out for, and then she's going to be available to help us if it's just more than you want to handle yourself. So give me a second, and there she is. Welcome.
Hi, Pam. Thank you for having me.
Absolutely. Okay, tell us everything we need to know, but just what we need to know and not everything that's in the tax code, because that's why it's so intimidating.
Absolutely, absolutely. So, thank you for having me today.
Of
Welcoming
course.
to your audience. So I know most of your audience are women that are thinking of or actually doing the hosting in their home.
Right.
So there's some tax secrets and some tax strategies that are very helpful for this group of people because what you've done is you've taken your home and made it into a business. There's some tax things that you definitely need to consider and a few things I want to share so to make sure that you're not only compliant, but also building wealth for your family as well. Because I know
Good. That's what we need.
that's why people do that's why people do the business, right? So
Exactly.
I do have some slides to share with your audience if that's works. But tell you a little bit about me too. I'm an enrolled agent, so meaning similar.
What does that mean?
Yeah, so sometimes people say CPA when they think tax automatically, right? An
Mhm.
enrolled
Right.
agent is a similar to CPA. However, the differences are CPAs are state licensed and
Okay.
really specialize in accounting, but a part of accounting is tax, right?
Hmm.
Enrolled agents are federally licensed as opposed to being state licensed. So we're federally licensed and
Mm.
specialize in tax, all things tax, tax law, taxation. So when you're thinking about taxes and tax strategies and all of those good things, if you want to work with a specialist, an enrolled agent specializes in that.
Okay. So that means people can work with you who don't live in your state.
Absolutely.
Like,
Yes.
okay.
Work with clients nation.
Fantastic.
Yeah, I work with clients nationwide. Some people, we've got a lot of digital nomads now that have moved all over the place. So I work with clients pretty much worldwide now. Yes, but I'm wherever the IRS touches, that's where I touch.
It feels like the IRS touches everywhere.
I do.
So,
Absolutely, absolutely. Yeah. So, but I think one of the things that a lot of times people, especially in the short term rental space, it kind of starts as, just testing the water sometimes, and then it becomes a full-fledged business. But a lot of times people miss some of the key ingredients to making sure that they retain the revenue that they bring in and also reduce their tax liability on top of it as well.
okay.
So,
That's what we want.
yeah, perfect. So I do have some slides I want to share with you guys. Let me make sure I know what I'm doing here. Let's see, here's my slides. Let me know if you guys can see them.
There you go.
Okay, so we're just going to talk about some tax advantages for those that are doing home hosting, right? So, help you to increase your revenue by proactively utilizing some tax planning strategies, right? So, this is me again, Katrina Martin. I'm an enrolled agent. Like I said, we're actually licensed through the Internal Revenue Service. Not We don't work for the Internal Revenue Service, but we actually all the testing that we take to become an enrolled agents it's actually through the Internal Revenue Service, and every year we have to maintain so many continuing education credits to keep our licensing active and keep our own taxes intact and all those good things as well.
Okay.
Okay. So happy host Academy, Pam. Thank you for having me. Definitely glad to share this with your audience. One of the things that I find a lot of times, and this is a stat that we've heard recently, 70% of small business owners don't do bookkeeping. And a lot of times when people are doing hosting, they don't necessarily think that they don't think of themselves as small business owners. They may think of themselves as I'm just renting out a room in my house, right? Or I may
Right.
rent out my house for a couple weeks. But the minute that you do that, you become a business owner. And the minute that you become a business owner is you need to start keeping track of all of your expenses and all of your income, because all of those things have to be reported to the IRS. And in order for that to be reported to your advantage, you need to make sure that you're keeping track of those things so you're not losing deductions, and that you understand the deductions that you can take. And one of the things that I have up on the slide right now is talks about why is bookkeeping important. Well, two reasons when you're doing home hosting. One is direct expenses and indirect expenses. So direct expenses are expenses that you pay that are only applied to the business part of your home. So say, for example, you're renting out a room in your home. Those are direct, and any costs that you incur for that, including painting, furnishings, whatever things that you put into that space, those are direct expenses that are there specifically for that part of your business. Indirect expenses are things that you can also deduct, but these are expenses that are paid in keeping up and running your entire home. So,
Mm,
say for example, if you're only renting out a room in your home and you still have use of the rest of your home, then there's a percentage of those costs that you have for the home that are indirect expenses, like your mortgage and your interest. But you can take a percentage off based upon how much of the space you're using in your home. So being very clear about what's direct expenses and keeping a list of those things, and then what those indirect expenses are. What are your utilities? How much of a percentage of that business is part of your home? So that way you can deduct those utility costs, the things that are associated with the internet, that portion of the internet cost, those shared spaces for the business and the home. Those are indirect expenses, but you need to keep track of them so you can make sure that you're properly taking the deductions for those.
got it.
Perfect. And then I think another thing that people get a little confused about sometimes is what's a deduction versus what's depreciation, right? So when you own your home and you're using it as a business, you have the ability to do some depreciation. Whereas if you were just using it for your personal use, you can't take any deductions other than your mortgage interest and your property taxes, right? And that's if you're itemizing for your taxes. But if when you become a business owner, you get to take deductions and you get to depreciate part of the home that you're using for the business, right? But we have to be clear about what's deductible, because a deduction you can take in the year that you make the payment. So, say, for example, if you paint the home, that's considered a deduction, that's like a repair. So,
Okay.
whatever cost you paid for that, you get to deduct that. Whereas depreciation means that it depreciates over time. You don't get to take that deduction in that first year. It spreads out over time. Like the purchase price of the home is something that you can depreciate against, but that's spread out over time. And if you make any room additions to accommodate for your home hosting, then that's something you're also going to depreciate. So just being very clear about what's repair means that you can take the deduction now, right? Whereas opposed to an improvement or depreciation means you have to take it over time.
Okay.
Okay. And then this is what depreciation looks like. I think a lot of times we hear the word depreciation, but it's not always clear about what we mean by that, right? So this slide means that, so I'll tell you exactly what it means. So the very first line, you see that there's a single family resident purchase. That means someone purchased a home for $200,000, right? Now, if you were renting the entire home out, you can depreciate that for 27.5 years. So what the formula looks like for that to determine what depreciation is, we would take that $200,000 that you used to purchase and divide that over the 27 and a half years, and that becomes your annual depreciation. So you'll take $7,272 off for 27 and a half years for that property if you're using straight line depreciation. And like I said, when you're doing home hosting, you can do that. You can use that depreciation formula for the percentage of the use that you're using for your home.
Okay.
Okay. And then what one of the things that I find a lot of times when people start with the home hosting space, they may not always, like I said, a lot of times people fall into business, or they fall into this and don't necessarily think of themselves as business owners. So what they'll do is they'll not get an LLC and not really protect themselves. They may increase their insurance on their home, but they not don't necessarily think of themselves as an entity, right? But I do recommend that if you're home hosting, that you do consider becoming at least at a minimum an LLC. And you'll see here that at some point you may want to change that election. That sometimes we see about $40,000. That's when we start recommending that people start looking into maybe electing to be an S corp or something along those lines. At least we start to visit what those entities do, because at a certain point those things start to cost you, because this as a sole proprietor or a single member LLC, everything's going to live on your personal tax return.
Right.
And depending on how you structure your business, you could be paying an additional amount in self-employment tax.
Mm.
Okay. So that's why choosing the right entity matters. And that's one of the things that we help owners do, home hosts do, because a lot of times they'll stay a sole proprietor, and a sole proprietor has no protection. As you may have, like I said, the property insurance, but the LLC at least limits your liability. So say, for example, somebody decides to sue your business, because as a home host you're a business owner. If somebody decides to sue you, they not only can go, they, if you don't have at least an LLC in place, they can try to attach that suit to your personal assets. And at least putting that LLC in place will limit your liability and protect your personal assets. Okay. And then let's talk about one of the things I talk hear a lot is talking people saying they want to build generational wealth, and one of the key ways is building generational wealth is through tax planning, because you're dictating how much tax you want to pay, and you're making sure ensuring that you've put enough plans in place to make sure what you want to happen is going to happen. A lot of times, what we find a lot is people, when they file their taxes in April, that they think that that's planning time. That's just preparing and sending it in, because remember, we're preparing for the year that already happened. So there's no adjustments that we can make because things have already taken place. So basically, the tax filing piece is just a compliancy piece to the IRS saying, this is what I'm reporting for last year. A lot of the information they already have. If you got a W 2, they already have it. If you got a 1099, they already have it. If you got a 1098 for your interest statement, they already have it. So it's really just like a piece where you're filing to say, in addition to the information that you already have, here's some additional things that I have. By the way, I have dependents. By the way, I have a business. By the way, these are the expenses I paid for my business. So you're going in there and you're shifting what they have already have on there on file as a reporting, and you're saying, hey, I see what you have, but this is the difference. And so you control that, but you can't control that in April when you're filing. That's something that has to happen right now and throughout the year. Is that clear for your audience, you think, Pam, or do you think I need to dig a little deeper on that?
I think that's a great way to explain it. I don't know that I've ever heard it that way, but I think that makes it much more clear. I love that. That was great.
Thank you. Okay, good. And so another way, you guys are already doing one of the key things that the tax strategies that are used by the rich, right? So number one is real estate. So real estate is one of the key strategies because there's so many benefits and so many opportunities and strategies that you can utilize with real estate. So that's one of the key tax strategies. So you've already checked that box for that one, right? And then option number two is one of the things that we hear sometimes is hiring your family. So if you have kids that are, that are still, and you're still responsible for, and their dependents, you can actually hire them to do jobs within your business, and it becomes a business deduction for you, and it becomes income for them. And if it's under a certain amount, this year's 13,900 or 13,500, if you pay them under that amount, then they don't have to file taxes on the federal side. You'll have to check your state because your state has different requirements. But federally, the standard deduction this year is 13,500. So if you pay them under that amount and they're under 18, then they don't necessarily have to file a tax return. So that's one of the secrets to hiring
That's
your kids.
that's great. I never thought about that. I've got a teenager who is now my employee because she's going to get to work
Yes,
starting
absolutely.
today.
Yes.
That's great. Yeah, I never thought about that.
There's tons of strategies. And then there's other ways that you can hire additional family members. The job needs to be something that they can do for their age. So you wouldn't say that you got a 7-year-old that's a
Right.
driver, something
Right.
along those lines. But you can have
Right.
a 7-year-old who does like janitorial services for your company and empties trash and things like that. It's not their household chores, it's actually work that they're doing for your business. And I
Love
know
it.
the kids do the social media because we can't keep up half the time.
Right.
So that's what those are just two key strategies, but there's 50 and greater. There's over 10 there's tons of tax strategies. You just have to make them apply to you and actually implement the strategy. So that's one of the things that we help our clients do. Two things that are key for determining a short-term rental, right? How a short-term rental is going to be taxed. So if you're treating your business, so there's two options, right? So if you're treating your short-term rental as a business, right, meaning you're providing some substantial services, and I'll tell you what that looks like. Then you can be taxed on what you would use as your tax form Schedule C. Schedule C is subject to self-employment tax, right? So that's something to consider right there. So you have these two options of ways to run your short-term rental, or you can run it as a passive business. And this gets carried on a Schedule E. And so the benefit of Schedule E is it's passive income and passive losses, right? So meaning you don't have an additional tax on it. So you don't have a self-employment tax. So those are two ways that those are two options for you, how you want to run your short-term rental. Okay.
Okay.
And then there's three factors in determining, how which category you fall under, the option one or option two, right? So number one is the average stay of the tenant. So short-term rentals are typically 7 days and under. So what you'll do is you'll take the number of days that you had your place rented out by the number of people and determine what's the average stay of a tenant. And if they're there under 7 days on an average per person, then that's typically considered a short-term rental. And then the factor number two that determines if you run in a short-term rental is were substantial services provided. And this determines whether you had a passive business or an active business. You had a passive real estate investment or an active business, right? And then the third option is, did you materially provide material participation? Were you active in doing anything with the business? Most times, if it's in your home, yeah, the answer is yes on that.
Right.
Uh, there's
Right.
there's no way around that one.
That's
But
it.
here's what substantial services looks like, right? Because substantial services determines if you're going to be a Schedule C, paying self-employment tax, or a Schedule E, treated as passive income, right? So substantial services means, and being home host means that this is something that you really have to look out for, right? Cleaning of the rental each day while the property is occupied by the guests. Changing bed sheets and other linens each day. So basically, anytime you're providing hotel-like services, that's considered substantial services, right? So if you're providing transportation, if you're providing meals and entertainment, if you're doing things along those lines, then typically you're operating as a business and not a passive business. So your short-term rental will be treated on a Schedule C. Okay, so those are things to keep in mind because that determines how much tax you're going to pay.
Okay.
So it's really important to know, what type of business you're running, and so you categorize it properly, so you'll have an understanding of what your tax liability is going to look like, and how to best move to save on taxes too. Okay. And then here's a video. I don't think I can play it on here. But I have a video that's on YouTube, and I'll share Pam, I'll send it to you so you can share with your audience as well. And I go into a little deeper about how to hire your kids, the proper way to do it, and the channels to do it. And I actually have a kit if you guys are interested in purchasing the kit that kind of gives you the contacts and all that good stuff too.
I
So,
thought you said I have a kid. And
oh no, the kids, look, my kids are look, they're adults.
okay, you're like they're not for sale though.
I'm not so. Well, we could talk about it now. I'm just playing. I'm just playing.
Maybe.
It's Mother's Day. We can't. No, my kids are out, they're not for sale. But you could put your kids to work. That's what you can do.
And I will.
They're
And I will.
And they don't have to just be under 18. They can be older. The difference is there's benefits when they're under 18 because there's not as much reporting. They don't have to file a
Mhm.
tax return if you pay them under a certain amount. You don't have to pay payroll taxes and all that kind of stuff. Whereas once they're 18, you do have to treat them like a regular employee. So if they're
Okay.
working, if either you have them as an independent contractor, you send them a 1099 at the end of the year, or if you have them as a W-2 employee, you send them a W-2 at the end of the year.
Or
Okay.
you just give it to them because they're standing right there.
To them because it's standing right there and they tell them to go file their taxes.
Right.
But when they're under 18, you have a little more flexibility, right?
Got it.
And then this is the two books that Pam that you mentioned that I have, and just a little bit more about me. We talked about me being an IRS enrolled agent. I am a veteran, so I do have a veteran-owned business through, for government. We do some contracting stuff as well. I own Wild Tax and Advisory Service based out of Michigan, but like I said, I work with clients everywhere. One of the things that my firm offers is we help people build out tax plans, and a lot of times people are like, who are tax plans for? Is it for me? It sounds like it's something for the wealthy. And actually, it's for the people that are middle class a lot of times and business owners because we're taxed at the greatest amount. The wealthy have people that are working on their behalf at all times. Think about Donald Trump. He has a whole team of people that are doing a whole team of accountants that are working on his taxes around the clock. So, of course, that he's got a tax plan that's constantly being implemented, optimized, and watched at all times. But you don't have to not have that same type of setup. We help you. We have a DIY method where we teach you how to build your own tax plan, or we have a done for you method where we build your tax plan. And this is ideal for those that are self-employed. This is for those that are high earning W-2 earners that are paying taxes out of the wazoo every year. Definitely business owners, specifically real estate investors and hosts, and even CPAs and bookkeepers want to learn this system too. So we work with them as well. Okay. And then I have put this link in here too for your audience, Pam, to book a consultation or just book a time to chat so they can learn more and we can find out, which option would be best for them and, just answer any questions that they have. And it's at buildataxplan.com. And there's some of my social channels as well. So if people want to contact or anything, but that's definitely something I wanted to open up to you just for them to book a free consultation.
Thank you. That's fantastic. I can't imagine someone not wanting to take advantage of that because we all have to deal with this tax situation.
Absolutely.
Nobody is exempt from this. And so, why not get, some advice from an expert and then see what happens from there. Maybe, maybe that's a relationship you want to build further. I think your presentation today was fantastic. I mean, who knew I could put my kids to work?
Thank you.
So, if nothing else, but I appreciate your time. That was really informative, and I just want home hosts to take away that they are a business, and just because it's in your home doesn't take you out of that realm, and doesn't mean you don't have to address these issues just like any other small business. So that's the main takeaway. The other main takeaway is to contact Katrina and let her help you with this because it's uh, personally it could be a bit overwhelming. And so I don't know if you feel that way, but I would love to have somebody else in my corner helping me out and showing me all the things that I don't know about taxes.
Absolutely, absolutely. Thank you, Pam. No, thank you for having me. It's great to chat with your audience because, as you know, this is one of my favorite topics. I love taxes and real estate, especially with those with short-term rentals, because people, like I said, a lot of times people fall into business, especially a short-term rental host. It's when you're renting out a space in
Right.
your home, and you start to think, well, I got my receipts, and it's like, but that doesn't really help you at tax time because you if you got some Home Depot receipts at any given time, they fade. So you don't, you
Yes,
never
they
know.
do.
You never know what it was for. And I typically recommend that you do use a tax bookkeeping software like QuickBooks or Zero. However, you don't have to start there if you're just getting started and you just want to, you haven't really started to make the money yet, just set up an Excel spreadsheet. Build it out. Put a January tab all the way through December. Write your income for that month and detail out your expenses for that month. What did you spend in advertising? What did you spend in office supplies? What did you spend on utilities? What utilities were they? Just keep track of your information. And then once you start to earn at least $10,000, once you break that mark, set up a system, because it's a write-off. Working with an accountant is a write-off. Paying for software is a write-off. These are business deductions. So these
Mhm.
are paying for
Taking a
every.
course at the Happy Host
There
Academy,
you
that's a
go. That
write-off.
education is a write-off. So don't cheat yourself trying to save a few dollars, because it ends up costing you hundreds and thousands of dollars on the back end.
Yes. Great advice. Thank you so much for your time today. Make sure, let's put that slide back up with your information. If you need to reach out, take advantage of her wonderful offer, and we'll see you next week. Bye.